Hello and welcome to the program. I am Nnaji, and this is Moneyline with Nancy. What is making news, of course, on the financial beat or in the financial circle is the CBN MPC reduction of interest rates to 11.5% from 12.5%. After the two-day policy meeting on Tuesday, the MPC reduced interest rates to 11.5%. Some Nigerians will want to ask, how does this really affect me? What does it really mean? I will be giving you an expose into what those decisions are. Of course, days after or the day after the MPC, I try as much as possible to analyze an X-ray, scrutinize the communique that is always released on the day, that's some hours after the MPC meeting. These decisions, what do they really mean for the economy, especially an economy that is struggling during the pandemic? We're having a lot of pandemic pain right now. Nigeria's economy, even before the pandemic, wasn't doing as good as it should do. Then the pandemic has worsened it. To speak about the communique today and perhaps the devil in the details, like I always say, Dr. Hassan Mahmoud, the Director of Monetary Policy Department at the CBN, will be joining me shortly to take a look at that. But let's quickly take you through the highlights of the September MPC meeting. The September MPC meeting is the 5th in the series of MPC meetings. I've always said here on the show, the MPC, which is the Monetary Policy Committee, meets 6 times a year. The last meeting will be held in November. But let's take a look at the highlights. We have that now so that we can quickly put it on the screen. The MPC, like I said earlier, reduced MPR from 12.5% to 11.5%. Perhaps some people may say it was a surprise move. Was it a good move? I'll be asking Dr. Hassan Mahmoud in a short while and what that move means. Increase in energy costs, pump price, FX price adjustment put pressure on inflation. That the governor of the central bank did mention. And he definitely said that there should be a broad-based fiscal and monetary effort to bring down the impact on inflation and especially on food prices. He mentioned yesterday that we saw more of physical and structural factors impacting inflation. Traditional monetary tools might not just help in bringing down inflation, according to Emmanuel on Tuesday. The MPC also expressed confidence in the Nigerian banking system. I remember I asked the governor on Tuesday if our Nigerian banks are indeed sound and can they withstand this pain that the pandemic has brought upon us if we have a prolonged contraction, or perhaps if we enter a recession. And the governor answered the question. So you get to take a look at that, especially as we're seeing in the US when the Fed has ordered another round of stress tests to check out if US banks are indeed strong to withstand this pandemic. Let's quickly take you through some excerpts from what the governor of the central bank said, Godwin Emefiele, in case you missed that on Tuesday.
Committee's decision. In the face of declining economic growth and rising inflation, the committee faced a difficult set of policy choices requiring trade-offs and sequencing. Following the above considerations, committee reviewed the choices before it, bearing in mind its primary mandate of price stability and the need to support the recovery of output growth. Consequently, committee noted that the likely action aimed at addressing the rise in domestic prices would have been to tighten the stance of policy, as this will not only moderate upward pressure on prices, but will also attract fresh capital into the economy and improve the level of the external reserves. It, however, noted that this decision may stifle the recovery of output growth and thus drive the economy further into contraction. On easing the stance of policy, the MPC was of the view that this action would provide cheaper credit to improve aggregate demand, stimulate production, reduce unemployment, and support the recovery of output growth. Committee, however, observed that with inflation trending upwards, easing of the policy stance may exacerbate the current inflationary pressure through an increase in money supply. In addition, MPC noted the tendency of an asymmetric response to downward price adjustments by other depository corporations, thus undermining the overall beneficial impact of a reduction to the cost of capital. In the committee's view, a hold position would allow the economy to adjust to the ongoing stimulus measures put in place by the monetary and fiscal authorities to curb the downturn and allow more time for the MPC to assess their impact on the Nigerian economy. After the consideration of the three policy options, members were of the opinion that the three options to lose will complement the bank's commitment to sustain the trajectory of the economic recovery and reduce the negative impact of COVID-19. In addition, the liquidity injections are expected to stimulate credit expansion to the critically impacted sectors of the economy and offer impetus for output growth and economic recovery. In view of the foregoing, committee decided to reduce the MPR by 100 basis points to 11.5% and adjust the asymmetric corridor to plus 100 and minus 700 around the MPR. 6 members voted to reduce MPR by 100 basis points, 1 member by 50 basis points, and 3 voted to hold. 9 members voted to change the asymmetric corridor, while 1 member voted to hold. All members voted to hold the CRR and the liquidity ratio. In summary, MPC voted to 1. Reduce the MPR by 100 basis points from 12.5% to 11.5%. 2. Adjust the asymmetric corridor from plus 200 and minus 500 basis points to plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5%, and 4. Retain liquidity ratio at 30%. That what do we think has been the impact of the global COVID-19 pandemic on the financial soundness of Nigerian banks? But let me respond to this by saying that ordinarily what some critical analysts will say is that as a result of the lockdown, both people and companies will not earn revenue, and because they are not going to earn, or they are not earning revenue, they will not be able to pay salaries, and if they cannot pay salaries, they will not be able to pay their loans if they took bank loans, and of course, if they cannot pay their bank loans, that it will result in non-performing loans in the books of the banking industry. But we believe that realizing that this could be the consequences of the pandemic, not just on households and businesses, but also on banks, we took the unanimous decision, supported by our board and MPC, to say that the CBN should consider the possibility of granting some kind of provisioning dispensation for banks. What does that mean? That banks are given the opportunity that if, for instance, companies or households or businesses that are impacted by the pandemic, that the bank should give, if they cannot pay their loans, that those loans should be restructured with the understanding that truly they have been adversely impacted by the COVID and that they cannot service those loans, or they have not even been able to pay salaries, let alone servicing their loans. We also took a decision to say that let us reduce interest rates on CBN intervention facilities from 9 to 5%. You are a cleaner somewhere, you lost your job, that we should be able to make available to them what we call 100 billion naira targeted facilities for household and SMEs. This facility has been granted and we're talking about 500,000 naira to somebody who wants to start a petty business, and up to 1.5 billion naira to some of them who are going to be undertaking some slightly higher level of business. We also decided that we would grant additional loan facilities even to some of our large companies. We decided that 100 billion naira should be set aside for companies that are in the healthcare and the pharmaceutical sectors. So what we have done, in essence, is to look for one way to reflate the economy so that people who lost jobs or people who could not pay salaries can come back again. And we believe that with the loans restructured, at least for some time, interest rebates on their loans and the rest for about 1 year, that the level of NPLs will in fact, at worst, remain stable, or at best, we could even see it coming down.
Hello YouTubers, welcome to Moneyline with Nancy TV YouTube channel. This is where we provide you with instructive business directions, processes and guidance to help you assess the right resources to fund your businesses to withstand every form of internal and external shock. You will find here awesome informative videos on business, entrepreneurship and lifestyle just to help you make informed business and financial decisions. Punch the subscribe button and let us drive you through the world of business. Please follow all our social media platforms on Facebook, on Twitter, on Instagram, on LinkedIn, and follow us for latest updates on our website. Welcome back to the program. In case you're just joining us, it's time for our conversation right now. Dr. Hassan Mahmoud is with me at the table to dissect this communique, like I said at the beginning of the program, and perhaps take a look at the devil in the details, like I always call it, because this communique, it's not just the decisions, the news, because we get to see the decisions, MPC reduce interest rate, there's a lot more in this communique. Welcome, Dr. Mahmoud, to the program again. It's good to have you.
Thank you very much.
Okay, now let's get started. And let me start from asking this primary question. However primary it is, I think it makes a lot of sense in terms of what does the MPC decision really mean? You know, because we saw that the MPC took a dovish stance yesterday. And what I mean by dovish, for those of you asking, what is Nancy saying again? Dovish means when the MPC, that is Monetary Policy Committee, takes an accommodative stance, unlike a contractionary stance. I hope I'm making sense. Okay, when they did not tighten, when they loosen, is what dovish means. So what does the MPC decision really mean for Nigerians that are watching now?
Thank you very much. MPC 1 is supposed to give a direction as to how we expect the economy to behave. How we expect the macroeconomic indicators, the direction we want it to go. And those decisions are taken based on, the prevailing trend of those macroeconomic indicators, which include inflation, exchange rate, employment, growth, and all other factors, including things that happen in the money market. So and number two, the monetary policy rate is supposed to give a signal. That is the rate at which the bank transacts with the commercial and merchant banks. So it's supposed to give a signal to the direction of rates in the domestic economy. However, the monetary policy is also cognizant of the fact that there are some, transmission mechanism difficulties between the rates, the monetary policy rates, and the money market rates. So that transmission mechanism is what is also informing the use of additional tools to direct the trend of rates in the domestic economy. So cognizance of that means that while we are looking at the monetary aggregates and looking at the monetary policy tools, we also need to bring in some other innovations in terms of instruments to use to direct the movements in rates in the domestic economy, particularly addressing the price stability mandate of the bank. So MPR is supposed to signal the direction, and like you mentioned, going expansionary means we want more liquidity into the system, we want credit to grow. Going contraction is we want to bring down inflation numbers, we want to tighten, we want to increase earnings to investors. So different objectives, but you need to sequence it and then take your priority at any particular time, given the prevailing conditions.
You know, on Tuesday, when the CBN governor, as well as the MPC, was talking about some of the decisions, they did also mention, especially coming from that inflationary point of view, that what we're saying concerning inflation right now is not monetarily induced. Yes. Can you speak a lot more about that? Yeah,
I think what the MPC was confronted this time around was, like they call it, a dilemma. One, there's a stagflation. Generally, inflation numbers are going up. It's supposed to drive growth. However, growth is reversing. Growth is going down. So you have, and then the external sector is also not doing very well. Exchange rate inflows, foreign inflows is dried out, exchange rate depreciation is going on, balance of payment deficit is rising. So you have three buckets to look at. One, your primary responsibility is monetary and price stability, conducive for growth. So the price stability is not in isolation. It's targeted at something. So growth, employment. And all economies, most economic, of the main economic objective is reaching full employment level, you know, where your income level reaches an equilibrium position, per capita income is high, everybody is employed. Not everybody, but a reasonable percentage is employed and stuff like that. So the issue was, okay, inflation numbers are going up. How do you bring it down? Simple is to tighten. Tighten so that interest rate goes up. When interest rate goes up above the inflation numbers, then you start seeing the economy shrinking. However, we are in a crisis mode. And the crisis means that we already saw the contraction in Q2 2020, very huge. However, it was moderated by what was done before Q2. So we also have to bear that in mind. Then the question is, what is driving this inflation number? Let's say food prices. What is driving the increase in food prices? It's structural issues that are not related to monetary. So no matter how much you induce, you know, the system or the agricultural sector and stuff like that, so long as there is flood, there is security challenges, there are infrastructural issues, there are storage problems, there are pesticides and all this.
Which is out of the CBN.
Which is out of the purview of the CBN. So long as those issues are coming up, then your monetary policy instruments at addressing that will not be efficient.
So isn't there also a risk for the monetary induction that the CBN is doing in terms of intervention? Because if you also put a lot of money into agriculture like the CBN is doing, and there's flooding, there's insecurity, there are other structural factors, it's a risk even to the money investment.
Well, in terms of that, which is a different ballgame, number one, the facilities interventions by the CBN are insured. So in terms of losses to the bank or to that fund, that bucket of fund, that is significantly minimized. But that does not stop the supply shock. Even if you have insurance cover, the food is still not in the market. So the financial side of it is resolved. A lot of that facilities are insured, and it is part of, you know, the loan package. However, the supply in food to the economy, it's very critical. And we talk of food security and stuff like that. And also the jobs that are going to be generated through that production process is also very important. Because don't forget that we are not just looking at increasing aggregate supply. We're also looking at increasing aggregate demand. Aggregate demand comes in from employment and disposable income increasing.
Purchasing power.
Yeah, so that, purchasing power, so that people can buy what is produced. And that is what will bring the second round of production and supply side. So we are looking at those simultaneously. So the fact that those factors that are driving the food prices are outside of the purview of central bank will mean that the central bank will have to use other tools to drive output. And that is what informed the intervention activity. So the intervention is not because the bank wants to go into intervention, but it's because the bank wants to achieve its objective of price stability. So it's like you are trying to pull a cow maybe to the river and it's not going, then you go and push it from the back. You know?
And it's really been a difficult task.
Yes, it's a difficult task.
In the last 1 to 2 years, it's been a difficult task because, like the CBN governor said, inflation is rising at least. This is the 12th time.
Yes,
and I think this is the highest inflation we've gotten at least in the last 4 years.
Yes,
so crisis, it's a difficult task.
It is. It is. It is a very, very difficult task. But however, and it's a global thing now. You know, the unconventional interventions or the monetary easings or the quantitative easing, whatever you call it, or even the direct helicopter funding to households and income. It's just another important thing is the fact that we are in a crisis. And in a crisis situations, normalcy does not prevail. So also is the way you try to address the crisis. If there's a fire in this room now, the way we walk out one by one is different from when there's a fire. So it's a crisis period, and we need to be cognizant of the fact that normal or conventional or standard tools may not be as potent as when it is in normal times. So we need to juggle things, and don't forget that the objectives of the banks, you are supposed to stabilize exchange rate, liquidity there. You are supposed your price stability is supposed to drive growth. You are supposed to have moderate interest rate in the domestic economy to drive credit to the real sectors of the economy. Since don't forget that even the banking sector also faced some risk in some of the, particularly the agricultural sector. And the nice side we had was to de-risk the agricultural sector and also to go into the value chain. So it's not just producing the rice, but processing the rice and making different things from the rice that you can, add value to that product. And that process will create a lot of employment and integrations and backward integration to the rest of the economy.
The MPC noted, in fact, when the governor was reading the communique, there was a point he got to the dilemma of monetary policy. Yeah. And I almost wanted to tell him it's not dilemma. This one is more than dilemma. Yes. Whether you're in a trilemma or multilemma, yes. If there's anything like that. Yes. Where I'm also going to is that which risk is the most hardest risk right now for the MPC and the CBN to face? Is it that of exchange rate volatility, or is it that of inflation? Is it, you mentioned stagflation earlier, which is unemployment, inflation rising. Yeah. So which is the highest risk that is staring the MPC and the CBN in the face? Then the second part of the question also is the CBN also abandoning the quest to tame inflation and going for growth?
That you have just mentioned the three trilemmas in the problem. All the risks are important, but it depends on which one you want to pick first. The point is, the science of it is that you cannot attack the three risks simultaneously. The simultaneous attack on the risks will be given a different reaction from different sectors. So pick your biggest fight or pick your largest enemy and face that, and then you come to the other sides of it. Also, why picking this enemy or why attacking this risks? Also be cognizant of how efficient are your tools that you have. That is very, very key. If you want to go and fight a war, you know whether you have a machine gun or you have a Dane gun. So you decide on which to choose first. So yes, inflation, taming inflation, is the primary objective of central bank, even in the CBN Act. However, it is also said that price stability conducive for growth. So ultimate target of monetary policy is also growth, and growth comes in from employment. So you look at that side of it, and then you also have issue to, ensure the stability of the domestic currency. So in that, you look at your reserve, you look at stability of exchange rate, and then you have a big shortfall of financing gap within the economy. So you need foreign inflows, both domestic and external. So you also need to look at that external balances. So you have that three buckets to look at. Which one do you face now? One, we're in a crisis. The economy is contracting, has contracted actually. The second contraction is expected or is projected to happen in the second quarter. If it happens in third quarter, if it happens in the third quarter, that's a recession. And then that will be, remember the last recession we had, it took us, look at the period it took us to get out of it. So it is better you avoid that as much as possible by putting in all the tools you have now before that happens, and then you can now minimize the period at which you will be in the crisis. So what the choice the bank has to do, has to deal with, it's one, yes, inflation numbers are rising. If we go expansionary, you are still injecting more liquidity into the system. Will that not propel inflation again, monetary induced now? But in the MPC communique, the governor also said that there are ample evidence to suggest that what is driving this inflation is not monetary induced. So, and then also in the report is the analysis that we have large potential output gap. So even if you are looking at attaining to full employment, there's still big room. If you see the advanced economies now, their inflation number are less than 2%. Their rate is more or less zero. Some are even negative. That means those economies have reached their saturated points, full employment. However, so at that in that level, monetary policy tools are not even efficient again. And that's why you see this huge asset buyback, injections to corporate in the US, over how many $1 trillion was pumped into the economy by the Fed. So those injections that came in substantially are also supposed to drive this out supply side implications. So the bank the committee was of the view that if we try to resolve these structural problems and push output forward, then the rising price will come down, because you now start having excess supply. However, if you're also doing the effective demand-induced activities, that also raise disposable income, and people were able to take off and reduce the inventory buildup in the factories and stuff like that, and then that will bring down the price. So using structural tools now to bring down the price. And what tools do you have? Is these developmental interventions in the power sector, in the agricultural sector, in the manufacturing sector, and then when you push that output numbers up, then the increased supply will bring down the prices. And if that happens, then you can start looking at exchange rate issues. You can start looking at how the domestic market can be able to mobilize, resources. The banking system is actually very highly liquid now. You know the amount we have in CRR. So what the argument is, put these monies into economic activities. Don't keep this money for treasury bills or investments in money market instruments that you just trade in those facilities, including foreign portfolio investments. We want FDIs, monies that will come and stay 1 or 2 years in the economy, build factories, build industries that will employ people, not just trading at the window, just make your gains, and when there's crisis, like now, everybody wants to move out, $2 billion want to go out. That's not the kind of money we want. Okay.
Now, since you've come to that intervention, let's take a look at it, because the MPC dwelled on those total disbursement from the banks, and I hope my team puts those figures on the screen. I can see a bit of it right now. But let me start from what the bank did say, or from what the MPC said, the bank's intervention, because I need to do a distinction between MPC and the bank. In fact, what's the distinction? Say it, because there's a difference between the Monetary Policy Committee and the CBN. So just quickly say that before.
The Monetary Policy Committee constitutes the members of the board, the Committee of Governors of the Central Bank, the Governor and the 4 Deputy Governors, and then you have external members appointed, some by the bank, some by the President. So the committee is more than the bank. So when you start, you will see that in the communique, they said the committee advised management or advised the bank or directed the bank to do this. So the committee is a larger body, including other professionals, academia, experts outside the bank. Yeah.
I needed us to make that distinction, because I see that a lot of people
mix it up.
Yes, mix it up. They don't understand it. So having said that, total disbursement from the CBN's intervention, the governor did mention that in the wake of this pandemic is total to 3.5 trillion naira, including real sector funds at 216 billion naira, COVID-19 targeted credit facility out of the 100 billion. In fact, let me break it down. 50 billion was initially said at the beginning of this pandemic, and additional 50 billion was added, making it 100 billion. So out of that 100 billion, the central bank says that something 3.69 billion has been disbursed. So we have about 16 point something billion or so left, or 17 billion if I'm not mistaken. Or is it 27 billion or so? Do the maths yourself. Anyway, the Pharmaceutical and Healthcare Support Fund, 44 billion has been put in that sector. Creative Industry Financing Initiative, 2.93 billion. Then under the Real Sector Funds, a total of 87 projects that include 53 manufacturing, 21 agriculture, and 13 services projects were funded. In the healthcare sector, 41 projects, which include 16 pharmaceuticals, 25 hospitals, and healthcare services were funded. Where I'm going to right now with my question is that we're seeing some kind of income support from the central bank in the for these initiatives. How do we measure value from these initiatives? Because if we take a look at it, it seems like a fiscal band-aid. I'm not just talking about Nigeria, because the question and also the concern for me is that how long do we do this fiscal band-aid? It's like you're having a strained arm and you put a bandage on it. How long will it stay? And how sustainable is it? Number one, is it even sufficient? Because analysts have also said that all the interventions we're seeing is just a tiny drop in an ocean. For us to see that effect, we should have like 10% of our GDP. This is not up to it. So how how much value, that's the one question, how much value are we getting from these initiatives? And number two, is it sufficient? Is it sustainable?
Yeah. That is a very, very important question, because even for the quantitative easing that central banks are doing, the greatest problem is how do you pull out of it and let the economy run on its own? Yes, because pulling out could also be very distortionary. So you are getting in, yes, you need to get in, it's necessary, then you are going on, then you need to pull out. The pulling out is also needs to be very, very systematic and organized. However, the point I want to also add to this is the fact that as central bank or the monetary authority is getting into all these interventions, you should be looking at the fiscal side. What are the constraints there? Why does central bank need to do that? Why is fiscal authority not taking up those responsibilities? It is clear they don't have the funds. Now crisis, inflows, the only source of revenue or the largest source of revenue is the oil sector. So the central bank interventions, one, are to address one, to increase these revenue sources, including the foreign inflows. So the interventions in the export stimulating facility, in the manufacturing output facility, in trade, financing, are one to diversify this the revenue inflows to government, and also to make the economy have, private sector, efficient private sector driven. Because generally, in short, another analysis that was made is that what proportion of the GDP was the revenue to GDP ratio, earnings, of government outside of oil. It's less than 10%. Most economies, the UK, the US, about 40–50% of their comes from taxes and all those. But the economy here is low, employment level is low, the participation in the economy is also low, so you don't expect that proportion. It's people that get jobs and companies that are functioning that pay taxes. But if they don't have that big bucket, then you have a shrink in revenue inflows there. Secondly, what proportion of the people pay those taxes? That's another ballgame entirely. So my point is, you look at the fiscal side deficit and the space, the fiscal space that is available, or buffers that is available to finance some of this infrastructure or fiscal things. So the central bank side of it is to, one, stimulate private sector growth that will be able to finance those economies. Dangote is building a refinery. It's not a government. But the refinery is building is bigger than any refinery Nigerian government has ever built. So it's a private endeavor that was developed in this economy, made its earnings from this economy. So by the time you have those big corporates that are developed, and this financing and all these interventions are supposed to grow up those kind of, large corporates and stuff that will finance this kind of infrastructure facility, including the Infraco that just came in on board of 15 trillion naira. So if you have those kind of burdens of roads, of transportation network and stuff like that, power taken off from government, let them face security, let them face democracy, let them face rule of law, things like that that will facilitate, businesses, ease of doing business. Let them invest in those ones and then take this off the hands of the government because of the lean resources. Then you see a lot of development coming in. So the interventions is, one, to grow that sector, two, to support these deficiencies that we are finding. Number two, the economy is also in crisis. So inflows now is really drying out significantly. So where will the funds come from? So
it's really a trilemma or multilemma, if there's any English like that. Why I'm saying so is because what kind of strategy will get us out?
Yeah.
Because what we are doing right now is first aid.
Yeah.
But what kind of strategy will get us out? Is it a consumer-led strategy, which we're seeing right now in terms of income support? Or is it more of like an investment-led strategy that will get us out, that could be sustainable?
Yeah, well, it's both. You need investment-led because the investments or supply-led will need demand to keep the supply sustainable going. So, but the bottom line is the structural issues, the structural rigidities are so enormous, particularly the power sector. Because if you have this power, everybody has power. People that are doing their barbing, organized, everybody has his job there. When you go to economies like the UK and advanced economies, it's not everybody that is a banker or is a director or is a top politician.
But the economic should work for everyone.
Yes. So, but what I'm saying is, when people can earn their livings, with their jobs, take care of their family, can afford to buy a car, can afford to take a mortgage and get a house, and you see, you have a large income streams that you can even earn revenue from, and can also participate in increasing the per capita income of that economy. So that is you need to create that demand, bucket to be able to drive that supply that you are looking at. So while you are pushing investments and private sector build up, you're also looking at what is the disposable income, what is the purchasing power that you just mentioned. So simultaneously you look at that. So both sides are important. Normally, central bank monetary policy tools are to manage demand short term. They are not for these long-term structural things. The fiscal authority are supposed to handle structural roads and power and stuff like that. But even that, they are supposed to facilitate, because you don't have the resources. But put down the right laws, put down the right property rights, put down the right legislation and civil service, and no corruption, stuff like these monies will come in. GE Electric that is coming into Nigeria, they need to get those assurances. They have huge investment out there, idle, that are looking for pockets of where to go to. So if you create your environment very conducive, those investments will come in there.
Let's take a look at the other policy. The loan-to-deposit ratio is 65% now, isn't it? And the MPC also did mention that growth in credit to various sectors from the banks increased from about 15 trillion to about 19 trillion naira. Is there really a risk, especially for financial institution soundness moving forward, if we have a prolonged contraction? Because analysts have said it's glaring that if we contract again in the third quarter, we definitely have entered a recession. Can the banks really survive, let alone thrive, if we have a prolonged contraction or perhaps a recession? Even with these numbers we're seeing, sometimes I tend not to look at these numbers.
Well, for the banking sector, yes, there's a risk if the crisis prolongs. And that is also, that's already crystallized in the recent time. You saw a lot of, in the report, there was a lot of forbearances for banks, restructuring of facilities, particularly those that are exposed to oil and gas, manufacturing, trade. A lot of, 40-something% of that was restructured, and forbearances were given on the part of the regulatory authority to allow the banks to cushion this effect. However, the comfort part of it is that the financial soundness indicators look very robust, in the sense that there were a lot of consolidation in the banking system before the crisis. So they are able to withstand some of these facilities, including the restructuring that was allowed. Ordinarily, you are supposed to meet some regulatory requirement, prudential threshold. Some of those were relaxed to allow the banks to have room to restructure this facility. Also to give room to the customers, the businesses that are in crisis and cannot pay. So if somebody cannot pay, you don't keep charging the interest or recovering his properties. That will not even bring the money. But restructure, give him some time, let the businesses pick up, let the lockdown go, and then the person will start repaying. So risk to the financial system, it's there. Vulnerabilities is there. However, the cushion is that capital adequacy ratio is still strong. The banks have the capital to drive additional investment. There's a lot of liquidity in that system too. So, and that is why you see the expansionary mode was to push these funds into the economy. Like I told you, you have huge funds, trillions of naira in the CRR. There's the Smith activity where banks are supposed to, where the banks are supposed to, come to the CBN, take part of their CRR and go and invest in businesses. The real critical sector is still there. The window is still there. However, there's also the economic risk associated with that, agriculture and stuff. But the banks need to create, the skills and the investment drive, or the credit management system that will allow them to, mitigate those risks. They are human strict and they're going to be there for some time. But they need to also develop products that will absorb those kind of risks within the system and put investment into that. And that's what the bank is doing through moral suasion, through all this cut in interest rates, to allow them to go into those sectors. So if they go into that, then that will reduce or will ensure the sustainability of the banking system over the period of the crisis and post-crisis. Finally,
yes, we'll end this session. During the MPC meeting, the outlook, in fact, the MPC did say that there are indications of a second spike in the rate of infections, talking about coronavirus cases globally, and that continues to dampen the prospect of a near-term recovery. Do you think our economy will be prepared to take the damage of the next few months if infections continue to rise and lockdowns looming. In fact, in the UK, just a few days ago, the UK government advised the citizens to continue to work from home, businesses to close at 10, unlike normally perhaps the 24/7 kind of economy. The nighttime economy has collapsed, definitely because of coronavirus. Israel, they went on another round of lockdowns and all of that. So do you think our economy will be prepared to take another hit or to take a stronger hit in the next few months if infections continue to rise? And lockdowns looming? And perhaps the other angle also would be the near negative interest rates we're seeing from the United States and from other markets across the globe.
Well, it's our hope that the lockdown or the infection rate, see, this was supposed to be a health
Doctor,
crisis.
do you know why I'm laughing?
Yeah.
Oh, I'm smiling. When you said hope, what came to my mind is perhaps I need to do the economics of hope. Now, what that will mean.
Even the IMF predictions are also based on hope, optimism that, well, things will improve, or because the health crisis has turned to a more devastating economic crisis. You know, so we are not really, yes, we are concerned about the death casualties and stuff like that, but the economic disaster is triple the health crisis. So the lockdown in economic activities, it's even the UK that did the recent, they still had rooms for, you know, work from home, some skeletal areas, it's localized so that they don't just close the economy entirely. And if for our own jurisdictions, Africa, West Africa, Nigeria, you know, the rate of infection maybe is due to test numbers, there are debate over that. It's not as severe or as devastating as those economies. But however, the lockdown created so much hardship, so much distortion in economic activities, such that all these problems we are seeing are coming in from there. So hopefully, and then there were stimulus packages to drive supply, to drive demand, to improve household income, to farms and stuff like that, even the conditional cash transfer, all those things. Hopefully, when those hit the system, and with the partial lockdown that we have now, and some businesses are opening, closing, earlier hours, if we're able to sustain that through the third quarter, then even if there's going to be a contraction, it will not be up to the minus 6.1 to 10% that we had in the previous. That is the hope, and the most optimistic hope is that fourth quarter will be positive, so that at the end of the day you can get, you know, a moderate, either negative or low minimal positive for 2020. However, it is still on the, you know, the hope is not just hope in terms of just sitting down there and hoping. It is hope in terms of putting things together, call them economic stabilizers, such that, you know, you cushion this effect on the peoples and the households and the businesses. And then you'll be able to, you know, get some better results in the third and fourth quarter of the year.
Dr. Mahmoud, I think we'll leave it at that. Thank you very much. I'll see you again, hopefully, November will be the last meeting for the year.
Yes.
All right, I've been speaking with Dr. Hassan Mahmoud, who is the Director of Monetary Policy Department at the CBN. Let's quickly take this break. When we come back, Emmanuel Adeleke, an investment analyst, will be giving me his own perspectives of what he thinks the decisions of the MPC, what it means to him. We'll be right back.
Nothing is more important than our children. Parents, the health of your children is in your hands. Don't send them out without ensuring that they are safe. As children prepare to return to school, what have you done to keep them protected? When it's time to resume, protect your child and others with CAS 3-in-1 Protection Pack. It comes with a medically approved face shield, a 100% cotton face mask, and a portable hand sanitizer spray approved by NAFDAC. Place your order and it will be delivered to your doorstep by FedEx courier service anywhere in Nigeria at no extra cost. Call our 24/7 call center at 09-904-1000 or visit our website at casppe.com.ng. CAS 3-in-1 Protection. Protect others to protect yourself.
African Economic Congress, this year celebrating its second edition, will see debates concerning key issues in African economies. Holding with the theme Post-COVID-19, Africa in the New Economic Order, with over 30 local and international speakers. Be part of the largest business event in Africa from the 2nd to the 4th of November 2020 via broadcast television stations and digital platforms. AEC welcomes government institutions, businesses to showcase their products and services during the Congress. For inquiries, please contact 0907 3703 649 or 0906 6912 600 or email events@aecongress.org. Registration is now open on the website www.aecongress.org. Join us at the 2020 virtual edition of the African Economic Congress.
Okay, is joining me right now via Skype. Hello, Emmanuel, and thanks for joining us. Hello, Emmanuel, can you hear me?
Hi, Christiana, can you hear me?
Hello, Emmanuel, can you hear me? I can't hear you. Hello? Hello, Emmanuel, can you hear me? Okay. It seems we're not able to connect with Emmanuel via audio, but as we try to get that sorted, let me just quickly take you through some of the decisions that we got from the MPC meeting on Tuesday. Like I said earlier, the MPR was reduced from 12.5% to 11.5%. The MPC also adjusted the asymmetric corridor from plus 200 and minus 500 basis points to plus 100 and minus 700 basis points around the MPR. The MPC also retained cash reserve ratio at 27.5% and retained the liquidity ratio at 30%. In fact, breaking down the COVID-19 interventions by the CBN, the MPC noted that the bank has, intervened in the economy, in different sectors of the economy, giving us the different interventions. Okay, I'm being told that Emmanuel can hear me now. Emmanuel, good to see you and welcome to the program. Let's use the last few minutes to hear what you have to say concerning the MPC decisions. Just can you give me in 30 seconds what your thoughts are on those decisions?
Okay, first of all, can you hear me clearly?
Yes, I can hear you now. Go ahead.
Okay, yeah. So the decision at the meeting just reflected the need to just boost economic growth. We saw Q2 GDP printed at 6% contraction. So what the CBN or the monetary policy is trying to do is they're trying to improve credit to the system as well as reduce lending rates. In addition, also they also reduce the asymmetric. They also adjusted the asymmetric corridor. So that has taken the SDF, that is standard deposit facility rates, to 4.5% from 7.5%. So that's actually meant to discourage banks from placing funds there. So what they want to do is that they want banks to, instead of placing funds, the banks should give the money out as a loan. So I think for the rest of the year, I think I always expect is that we're going to see more of these accommodation or monetary easing and stance from the CBN, just in a bid to boost economic growth.
Emmanuel, do you think that the looming recession can be avoided in Nigeria? Because if the economy contracts in the third quarter of the year, that means we're definitely in a recession. Do you think that this can be avoided even with all the interventions that the Monetary Authority and the fiscal policy makers are doing?
I don't think so. So there's a very huge possibility of the Nigerian in a recession in Q3. However, what I'm expecting is that I expect Nigeria to come out of the recession faster than most other countries, most likely by Q4 and even late Q1. I expect to see these interventions and all these policies are beginning to filter into the economy. So by Q4 latest, I should start seeing some positive growth in the economy.
Just as we begin to round up this show today, I did ask the Director of Monetary Policy Department earlier if he thinks that these interventions are sufficient and sustainable enough. What do you think? Because a lot of analysts have said that we need to do more than we're doing right now so that, the way the economy will just hit the ground will not be as, hard as it should be. Where do you stand on this?
Yeah, so I think I share the same view. I mean, I feel despite these whole interventions, even reduction of rates, we haven't seen that much impact in terms of loan creation. However, what's been driving growth in loans has been more of the CBN's loan to funding requirements. So personally, I feel until we adjust the structural weakness in the economy, that's when we'll start to see a meaningful impact of all these policies in terms of economic growth.
How do you see us moving forward? Because we have a lot of risk facing us right now, both structural risk and every other risk. But which risk do you think is the major risk facing us that we really need to attend to, that the government needs to attend to? You can take it. It may not also be within what we're talking about. What is the greatest risk facing us as an economy right now?
I will say FS risk is one of the major things that is affecting Nigeria, and the drivers for that FX is quite broad. First of all, we have the fact that Nigeria is quite imports and dependent. We also have the fact that most of our FX earnings is based on oil earnings rather than on oil. So I think those are the key problems, and those are the key risks that we actually need to address before we see tangible in the country. I mean, until we see stability in FX, that's when we start to see foreign direct investments come into the market. Investments that will typically stay longer rather than this short hot money that we tend to see. So I think these are the policies. These are the kind of policies most of the foreign guys are actually even looking for before they come to invest here in Nigeria.
Okay, I think we'll leave it at that, Emmanuel. Thank you for speaking with me today, despite the network not allowing us to speak for longer. Thank you for your time.
Thanks. You're welcome.
All right, that's Emmanuel Adeleke, an investment analyst, and that's the much we can take on today's edition of the program. Thank you for investing your time with us. But don't forget that you can join us on all our social media platforms. On Twitter, we are there, Moneyline TV. You can also find me on Twitter at Nancy Ilo. You can find us on Facebook, Moneyline with Nancy TV. On YouTube, don't forget to go on YouTube, our channel, Moneyline with Nancy TV. You get great content from there. I will see you all again. I am Nancy Nnaji. Don't forget to protect yourself. Thank you for watching our video. Please hit the subscribe button below, turn on post notification to follow all our updates.